Hey everyone, Eric here. In this video, I'm going to show you how to build the ultimate MarTech financial model. We'll walk through step by step a marketing technology startup scaling from 0 to 3.5 million in revenue over its first 3 years. By the end of this lesson, you will understand how to build a full financial model for your MarTech startup. Okay, let's get started. Okay, so let's build this marketing financial model. First off, MarTech just means marketing technology. This is a massive area as marketing software unlocks growth for many different industries and business models. For example, restaurants historically didn't do a lot of digital marketing, but now they can send SMS to people on their birthdays, let them know about seasonal dishes. There's so many opportunities to build marketing tools for all sectors of the economy, so it's a booming area of the startup ecosystem. First thing, I just want to point out something. When you're starting a startup, usually you'll start by building a single product that solves a single problem, and that's what you should do. But you always want to have in the back of your mind, how do you pivot from building one product into building a platform of products? Because you can't build a very large company just solving one problem. You end up needing to build a suite of solutions that you can be the marketing platform for X, not just the landing page builder for X. So I just want to keep that in mind. And it's important in terms of storytelling. If you're trying to raise money around kind of Series A, you want that line of sight to say, we are building a platform. Okay, so marketing technology really encompasses many different types of marketing software. So there's email platforms, affiliate marketing, customer support bots, landing page builders, SMS platforms, could be scheduling tools, SEO or link building tools, could be file editing, could be influencer marketplaces, and more. And so if you're building a platform, you want to build something that has various things. So let's just say that we start as launching an email platform, which is just basically an improved version of whoever we're trying to disrupt for the email. However, in year 2, and this is basically just kind of a layout of what we're going to do, we're just going to work on these 4 products right here. So we're going to say we're going to build an email platform, and then we're going to roll out affiliate marketing in year 2. Then we're going to roll out customer support bots, a landing page builder, and then in year 3, we're also going to roll out SMS platforms. And so if you're a customer, we onboard you because of our email platform, but then we can offer you all of these additional things. Do you want to make your customers your affiliates? Oh, do you want extra customer support? Oh, do you want a good landing page to drive emails to your list? Oh, do you want to do your email campaign with the SMS platform integrated and you can sort of do it all together? So this is us pivoting our company into a platform. So let's go build this financial model. So here's a kind of basic skeleton for our financial model. What we're going to do is we're going to look at pricing. We're going to look at, okay, how do we acquire customers? Given that these customers are on a subscription to these different products, like what does our churn look like, etc. Build out the expenses, and then finally build out the income statement. So sales, costs, expenses, profit, and then how much cash are we burning? What's our runway, and how much investor capital do we bring on? Okay, so here we go. So first thing, I want to just copy what we just did into here. Let's just Control V, and I'll just take off this border. So now we can just see here in the top, I have M1, M2, M3, and I've basically locked, if you just go to this cell, view, freeze panes. If you don't freeze them, you'll lose the furthest column to the left and this top row. But if you put your cursor where you want it to lock, just above and to the left, just go in freeze panes, freeze panes. So now anywhere we go on the sheet, we can see which month we're in, and we can see which sort of thing that we're working on. Okay, so here are the products as we roll them out. In the months, I listed it all the way to 36 months, so that completes our year 1, 2, and 3. And so now we just kind of need to follow this guide and build out the assumptions. Okay, so first things first, let's price our products. And so I'm obviously going to be kind of making this up. If you're building one of these companies, then you probably already have pricing in mind, but I'm going to show you how to kind of set up the skeleton of this model. So this is pretty easy here. All we need to do is just copy down our effectively product lines, and then customers percent use. So the basic idea here is that our primary product that we launch the business on is an email platform. And all of these additional products are things that we try to upsell to the customers, and so that they are using a suite of products. So this is the percentage of customers that use this. So email, it'll always be 100%. And assumptions in modeling, we always want to put in blue. So anyone looking at your model, or if you're just looking at your model, you know, okay, this isn't a formula, this is just a typed in number. So email is going to be 100%. And then let's see here. So we'll put this all in blue as well. And accounting format. Okay, great. So we're going to say that the email is $79 per month, because we're looking at months here. So $79 per month. We only really have the email platform in year 1. So we're going to extend that out to month 12. And so 100% of our customers are just using the email platform. Nobody's using anything else because we haven't launched anything else in year 1. Okay, so now let's move to year 2. And now we're launching in year 2 these 3 products: affiliate marketing, customer support bots, landing page builder. So let's say that we keep the price of email the same for this time period, and that the affiliate marketing product is $49, $29 for the customer support, and landing page builder could be $29. And so 100% of our customers are going to be using the email, and then if they're purchasing the email, then they would be able to buy these other products. You could build many variations of this model. You could say if they buy email, they get discounted affiliate marketing, or maybe they can just buy affiliate marketing and not email. You could build many variations, but I'm just building one that shows you sort of the skeleton of how you build something like this. So let's say that when we launch affiliate marketing, 25% of our email customers start using it, and the landing page builder, let's say 10%. Say, okay, yeah, we'll use your landing page builder because the other landing page builder we're using is too expensive. Okay, cool. So now let's bring that out to month 24. So that's the 2-year mark. So now we have been scaling our products for 2 years, and below we're going to look at the marketing and the conversions. So we'll be able to look at exactly how we're scaling. And then in year 3, we have the SMS platform coming in. Okay, so here we are in month 25, and let's say that in month 25, so it's the beginning of year 3, we actually do some price increases. So here, let's say we raise it to $89, and the affiliate marketing, let's say we raise it to $59. Let's say these are really popular products and very low churn, which means that you probably have a lot of pricing power because the product becomes indispensable for your customer base. Okay, cool. So we launched the SMS platform, and 35% immediately say, okay, we want to use that and do email campaigns and SMS campaigns all out of the same platform. Okay, so if we copy that forward, now we have pricing, we have the percent of customers that we're able to kind of like upsell these other things in our platform. And so now let's look at customer acquisition, because to calculate sales, we need the price, and then we need the amount of customers, and then we need the churn rate, so we can look at how many recurring subscriptions, new subscriptions we have each month, multiply the price by the subscriptions, and you have the sales. So let's kind of look at this. So if we think about a product like this, probably not so expensive that you need an actual sales team. You can probably do most of your customer acquisition online. Usually products that are $500 a month, $1,000 a month, a couple $1,000s a month, you need a sales team to do demos, many calls, because customers need to consider whether it's worth the investment and get really educated on the product. But with a product that's a couple $100s a month or $100 a month or less, usually you can do the conversion just with sort of like paid channels because it's not such a complex decision. So let's say, okay, what are our channels here? Let's say we're advertising here on let's say LinkedIn, Google, and Facebook. So Facebook/Instagram. So these are three channels that we are effectively we're saying that we're having success with. So let's make these blue, and then I'll just copy the format here. Okay, cool. So we're saying that in month 1, let's say we spend $5,000 on LinkedIn. Kind of makes sense that if this is a business product LinkedIn would be a good place to generate leads. Google, let's say we're targeting searches, a bunch of searches, SMS platform for X sector or whatever it is. So we're buying search traffic. Facebook, Instagram, we're sort of targeting different business people. And so the total is 11,000. And let's just say that we just keep the kind of budget the same for the first year as we try to figure out our customer acquisition. We're able to generate enough leads with spending about $11,000 a month and trying to figure out conversion that we don't want to scale before we know we're really good at conversion. Okay, so if we're buying this amount of traffic, let's look at the funnel. So how do we get from traffic to conversion? Well, there's a bunch of things. First, you buy traffic, you buy impressions, meaning you show your ads to people, and a certain amount of those people will click. So for, campaigns for like B2B campaigns targeting business owners, we're just going to start with a cost per click assumption of $5. And why do I say cost per click of $5? Well, it depends on the platform. Facebook is more impression-based pricing. Google is kind of more click-based pricing. It depends on the platform, but CPC of $5 would be a kind of a normal price, probably on the low end for a business targeting businesses. And then we're saying, okay, so if we spend $11,000 and we're paying $5 per click, we're going to get a certain amount of clicks. How many of those clicks can we convert to leads? Okay, so what that means is, we have all these people clicking. How many of those people, after they click, can we drive to a landing page and then say, hey, do you want to do a trial of our product or get on our list? Let's say 10% clicks to leads would be a strong number. And then let's say cost per lead. And so all you would do here, and I can put here the actual number of clicks, just so you can see clicks. So that's just taking 11,000 dividing it by $5 per click, and you would effectively have 2,200 clicks. So then we have clicks to leads. So how many leads do we generate? Okay, leads, we're saying that of the 2,200 clicks, 10% turned into leads. And so, okay, how many leads is that? It's 220 leads. So we've captured the emails of 220 people. We spent $11,000 to do it. So cost per lead is 11,000 divided by the leads. So $50 per lead. And this is, could be on the low end actually. I see businesses that have cost per lead. Certain sectors can be, a couple $100s per lead sometimes. Okay, but if our product isn't that expensive, it's probably easier for us to drive leads and drive conversions. So here we have, we're saying the conversion rate. Okay, so once we get a lead, what percent of these leads can we actually convert to being paying customers? So let's think about this. What would be a good conversion rate? Okay, let's say 10%. 10%, okay. So now let's look at conversions. So let's round this number. Of the 220 people we turned into leads, we convert 10% of them, and we want to round that to a whole number because obviously we can't have a partial conversion. So that's 22. Okay, so here we've converted 22 people, and we're saying these are paid conversions because we bought the traffic basically. And so what's our CPA? Paid, and this is cost per acquisition or customer acquisition cost. This is for our paid channels versus organic, which we'll get to in a second. We're saying, okay, we spent $11,000 for 22 people. It's costing us $500 a conversion. Okay, that seems about right. So now I'm actually going to pull a couple of these assumptions out. I'm going to say, okay, here's your clicks. Here's your leads. So you can kind of see the funnel. Clicks, leads, conversions paid, and okay, and this is into the email platform. We're saying email platform. Okay, so 22 conversions. So what about the customers that come in that don't come through paid channels, that come in through word of mouth, that come in through Google search, that find us on social organically? You get a lot of organic conversions with any business, and they're not necessarily attributable to one of your paid channels or not directly. So usually you get, for every certain amount of paid conversions, you get a certain amount of organic conversions. And you don't get that many in the beginning, but the number the ratio ramps up over time. So here's how I like to look at this. I like to look at paid to organic ratio. So here's an interesting way to think about this. So we're going to say that in the beginning, paid to organic ratio is 4. What does that mean? For every 4 paid conversions, 1 comes in organically, which is free. So organic conversions is going to be 22, basically divided by 4. And we'll round that number. Round to a whole number. Okay, so that's 6 conversions. And so we can now copy this across, and I just want to show the total conversions. Email, it's this 22 plus the 6. So I can kind of highlight in bold all 3 of these just to make sure this is like super clear. So that's 28 conversions. And so now I'm going to copy this across, and then we will mess with the paid to organic ratio because that number obviously kind of evolves over time. So first, let's fill in sort of a marketing budget that, let's say, ramps over time. So let's say here in month 13, okay, now we really want to start ramping up. We'll see down below, but we're going to raise another investment round about a year in. So $15,000, we bump LinkedIn. Let's say we bump Google now to 5K, and we're having good results on Facebook as well. So we bump that to 10K. So we're driving more and more leads. Let's say our cost per click is staying consistent at $5. Click to lead conversion. All of our other assumptions for the sake of our model are staying the same. Okay, so we can copy that throughout year 2, and then in year 3, let's say we kind of keep hitting the gas, and so we go from 15 to, let's say, 25,000 a month, and then 7,500. And let's say 15,000. And I think from there we can kind of just copy that out through the end of the model. So now we're spending $50,000 a month, basically buying traffic, trying to convert it to leads, and converting. So you can see your paid conversions are 95K a month here. Okay, but let's think about, as we scale this business over time, what do we think this is going to look like? So let's say that after 6 months, our paid to organic ratio starts going down. So that means now instead of we get 1 organic conversion for every 4 paid, 1 organic conversion for every 3 paid. So the word of mouth is getting out. Our product is good. It's getting popular. And then let's say it goes to 2. So that means for every 2 paid conversions, you get 1 organic. So that's like 1/3 of your conversions now are basically organic. And let's say by year 3, it's still a relatively young business, but let's say we actually get the number to year 3, 1-to-1. So a lot of our customers now are referring their friends, people are hearing about it online, et cetera, et cetera. Okay, so now you can see our sort of conversions ramp to 190 per month. Okay, so now we know how many people we're converting, but how many people are we retaining? Okay, before we move forward, if you're finding this content valuable and want to support me in making more videos, please subscribe to my channel right now and like this video. Also, if you want me to teach you everything I know about finance for startups in a small group, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. Space is limited in each cohort and it often sells out, but if you're on the waitlist, you'll have a chance to register 24 hours early. So if you want some more info about the program, definitely put your name on the waitlist. Okay, let's move forward. So now, let's talk about customer retention. So we know how many people we're converting. And so let's just link that in here. So we have these people coming in. And now let's talk about churn. So churn is the percent of customers that cancel each month. It's a metric that specifically applies only to subscription businesses. But let's say in this case, we're at a 5% churn rate. So 5% churn rate for B2B is decent, could be lower. But it's also a very solid number that you could build a business on. For B2C, churn rates can be very, very high though. 10, 20% are more common. Okay, so here's a table. In this table, we're going to look at new, churned, recurring, and then the total amount of subscriptions. So This is a very easy way to kind of build a active customer sort of chart for subscription businesses. So, okay, so here we have, oh, let's just move this down here. 28. Okay, so we had 28 customers here, and we're just going to add these guys up. So churned, let's say these are our first customers, so nobody churned, and we had no customers in the prior month, so 0 recurring. Here, we would say 28 customers were recurring, so we had 28 customers that came back from the prior month, but how many of those 28 customers canceled? In that case, we would say negative, and let's use the round formula again, so we don't round to a decimal. 5% of the 28% churned. So we're saying that that's 1. So here, if you total these 3 rows up, you'll see that you get 55. So what is 55? It's 28 minus the 1 churned customer plus the 28. And so if nobody churned, it would be 56, but because 1 person churned, it's 55. And so this you can basically just use for every month now to figure out what's your total sort of active email base. So if we copy this formula forward, we're saying that the amount of people subscribing to our email platform ends up being 2,200 by the end of year 3. Okay, so obviously we could change the churn rate over time. We could make it go up, we could make it go down, but that's just something that you can do when you're building out your business. Okay, so now let's pull in the additional products. So here we can just copy this. So we're saying that these products are sort of like upsells. So if you buy email, you can buy these other things. Okay, so let's do this now. So we know here that we have these percentages of, okay, 100% of people are buying email. Here are the percentages of the email purchasers that are also subscribing to these other products. So we're going to use the round formula just to round to a whole number, and we're going to multiply the total active email subscribers here just times the percentages. So this is pretty easy. We can say round email, and I'm tapping F4. You want to get the $ here in front of the row. So the $ in front of the number. Okay, so we lock the row, multiply it by the percent upsell, round it to 0. And so here, let me just pull this across so you can kind of understand this formula. What we're basically saying is that here, 340 times 25% equals the amount of people in your affiliate. And we lock the row, so we can copy this formula, and it always, this part of the formula here always stays locked on the total active subs. But this part of the formula here is unlocked, so it'll move up and down as we copy the formula up and down different rows. So basically, this just tells us how many customers we have and all these other products. And from here, it's really easy because we just need to multiply it by the prices to get the sales. And so we've almost got everything now. So you can see that by the end, we have 2,270 email platform customers, and then here are all the numbers that we have of all the other percentages. You know, we could build out a separate table for each one if we expected different products to have different churn rates, etc. You just build it exactly like this, but we're just assuming that the churn rates are all going to sort of track together. Okay. Now let's talk about the sales forecast. From here, we can calculate the sales forecast easily. And then we'll look at the COGS, we'll look at the expenses, and then we'll look at our cash. So, okay, revenue. So in the income statement here, we have our revenue. We just need to paste in the products because we have prices, we have everything. Okay, so how many products do we have? We have 5. So let's copy these in. So just copy the names. And by the way, in case you're wondering, in the description below, you can download this file completely for free. And so just look for that download link if you want to use this. Okay, so here we go. So how do we do this? So email platform is just active customers for email times the price. So $79. Okay, so here we're going to apply some formats. I like to do the accounting format and reduce decimals to 0 by clicking this little arrow right here. Okay, and so the next one is affiliate marketing, so we need to go grab that. We can't just copy it because affiliate marketing is a few rows down, but after this we can kind of copy everything else. So the number of active affiliate marketing clients times the price, which will be in this row. Okay, so from here we can copy everything else down, and here's the best way to kind of format this section. So in financial modeling, generally when you have a block of data, you just put like the accounting dollar signs or whatever currency you're in just on the top row and the bottom row, and then you can just apply the comma format to all the middle rows. And it's not important, but it does make your model look nice, and that's kind of an industry standard way of doing it. Okay, so we can copy this across, and if we wrote the formula correctly, we should see the numbers popping up. Okay, 23, and I like to spot check a random cell just to take a look. Okay, so landing page builder 192 times 29. Okay, so everything's linking in correctly. Okay, great. And then I like to add a row for if this revenue is recurring, meaning, customers basically are subscribers, you will take the revenue and multiply by 12, and it'll give you your ARR. So what is ARR? It's basically the annualized version of how much revenue you did last month. So if you did the revenue of the current month for 1 year straight, how much revenue would that be? So it's like your run rate. So you're saying that if you're doing 2K a month, well, if you have an entire year of 2K a month, it's this number right here. So you just take your monthly number and multiply by 12. A lot of valuations are kind of based on ARR, but remember that you can't just take one-time revenue like e-commerce revenue and multiply by 12 because that's not recurring revenue. So there's a big difference between your revenue and your recurring revenue. You might have a component of your revenue that's recurring and a component that's non-recurring, like something one-off. And so you need to make sure to break those out if you're going to be showing data. Okay, so here you can see that we get to a 3.4 million annual run rate by the end of year 3. So that's a pretty nice ramp for a business like this. Now let's move into COGS. Okay, so we're a subscription business. So what are in COGS for subscription businesses? Usually you have customer support. And so things that are in COGS are things that directly touch the product and the customer. So they're not things that are, not interfacing with the customer, like someone on the management team, someone on the, engineering team, the CEO, the office. None of that stuff actually touches the customer directly. That goes below in the operating expenses, but things that touch the customer directly need to go in the COGS. So we'll have a few things here. We'll have, we'll have customer support for sure. What else will we have? We will have the payroll expenses. So this is like benefits, 401k, like retirement stuff, etc., taxes. So that usually increases the cost of a person by about 25%. Then we will have hosting, because you obviously be paying a lot of hosting to host your platform, and then probably credit card processing fees. So that's called merchant services fees. So it's the 3% you pay for anyone who pays with a credit card back to the processing company. Okay, so let's go to our COGS and just kind of list out some of these assumptions so that we can build this into the model. So customer support. So let's think about this. Okay, so generally, how do you know how many reps you'd have? Well, with a software product, you probably have a certain amount of active accounts per rep. It might be another metric, whatever the metric is, you can build it into your model. If it's, let's say, emails sent per day or contacts or whatever it is, it's probably some kind of a ratio. So let's say we are saying that one rep can hire 200 active accounts. The website's really good, that there's not that much support that needs to get done. So 200 is an amount that someone can handle. Okay, so your total reps would be, now let's round up, because remember, as soon as you go over 200 accounts, you're going to need a second rep. So you're going to round up because you can't be rounding down here because one rep can only do up to 200 accounts. So we're going to take the active accounts, so the total active email subs, that's like our base customer number, divided by 200. And we'll round that to 0. So we're saying that there's one rep because we're under 200 accounts, so we'll only need one rep. But as soon as you see the number go above 200 here, 210, now rounds up to 2 reps. So we can just copy this forward and say, okay, by the end of year 3, that means that we will need 12 reps to handle 2,300 accounts. Okay, so we know how many customer service reps we have. Let's also say, okay, what is the salary of a typical rep in our business, in our sort of geography? Let's say it's like $50,000. So here, this is a really simple way that I like to forecast payroll in just like startup financial models. What you do is you show the number of people somewhere else in another part of the model, and then you just put the salary to the side. And what you can basically do here is say salary, just lock the cell, divided by 12. So that gets you the salary per month here. And you just multiply that by the number of people. So here, as I copy this number across, you'll see that once we go over 2 reps, if I copy this a few more cells, it jumps up and it just shows the sort of monthly payroll cost. So that's a really easy way to do this, and that's what we're going to use below as well. Now the PR expenses, so this is about 25%. So this adds about, usually payroll taxes 10 to 12% in the US, and then you have to pay another kind of 12% for benefits and the 401k matching, all this different stuff. So this basically, we take the base amount and we multiply it by 25%. So that's the other expenses. Okay, so now we have these two things. And so we're almost done with the COGS. Let's say that we have, we have the hosting, and then we have the merchant services. So credit card processing fees. So before we get into the hosting, this is generally about 2.75%. That's what the cards basically charge startups to process. I hope that gets disrupted one day because it's a huge expense, especially for companies that are like marketplaces that only take a very small percentage of the overall volume of sales from their platform. This can be like 10% of their revenue, 20% of their revenue. So that number's too high, but that's what it is for now. Okay, then hosting. So let's talk about hosting. So let's just say, this would be like with, AWS or whatever company it is. I'm just going to kind of put in some numbers here as a complete guess, just based on kind of numbers that I've seen, but I'm sure this is not super accurate. And so let's say it's kind of 2,500 in the second year. And so we kind of copy that forward. And then let's say it's, I don't know, in year 3, maybe 5,000. Okay, 5,000. There we go. And then this credit card processing fee is 2.75% of the net revenue. So how can we mix this stuff in here? We can just say hosting. We can just link this number straight in. Then we can say credit card processing fee. It's the revenue times 2.75%. And so let's use this kind of formatting like we did above. Let's do commas for the middle section. On the bottom, just sum the section up, put it in bold. And from here, we can just copy forward all of our nice formulas. Okay, great. Okay, so we're saying that we get to 281,000, 75K in COGS. Software businesses, you want them to have high gross margins, sometimes between 60 and 90%. So let's just kind of see where we're at. Here, revenue minus COGS. Oh, looks like we are missing a few rows here. Okay, so your gross profit here is this divided by this. So negative 161%, but that's just because you're not scaled up. So as you scale this thing, just because that one rep costs more than the 22 clients that you had. So as you scale it up, you see the margins kind of improving. And let's just see kind of what we end up getting to by the end of year 3. Okay, so here we get to like a 75%. So we're at scale, we're getting good efficiency out of our reps, out of our hosting, et cetera, et cetera. And so now we're at a 75% gross profit margin. Okay, so now all we need to do is fill in the operating expenses, and then we can look at our cash burn, fundraising, et cetera, and wrap this model up. So let's think about first our operating expenses. I'll put this in bold. So we're going to have payroll, so most of your team would go in here, and then we'll have marketing and then other expenses. So let's kind of go through that. So let's start with team. So we can go to this section here, OpEx assumptions, and let's list out our team. And what we're going to do is we're just going to list how many people we have sort of over the course of scaling this company. And again, this is just like a really easy way to do this and to think about it. So let's say we have the CEO. Okay, we have the CEO. We have, let's say, technology, marketing, creative, admin. So I just created kind of categories so we can just list how many people are in each category rather than having to list them out individually, especially considering that we probably don't even know the detail really on the future other than just sort of roughly what it's going to look like. So let's say we have one CEO. And then we have one person on the technology team, one person on the marketing team, and then I'll show you in a minute, but we'll have some other people who are consultants. Okay, so let's say we have this team of 3. They're trying to ramp it up in the first year. In that first year, we'll show down below, but we're going to say that they raised basically like $1 million and that they're sort of just working, the 3 of them and some consultants for the first year. And then going into year 2, they're able to actually raise a bit more money and start kind of ramping up the hiring. So they're going to hire, let's say, another person on the tech team, so probably another engineer, another marketer, someone, a creative person, and so someone in some other role, maybe a accountant or something like that. Okay, so now we go forward to the end of year 2, and again, I'm not claiming this is like the perfect payroll plan or something. I'm just trying to demonstrate things that I've kind of seen in the past. So let's say we bump it up to 3. So now we have people building product, people selling product, but still a very lean team. Okay, so here, all we need to do is make some space down below for our team. And how many people is that? 5 categories. Okay, cool. So what we're going to do is we're going to just take these people, we're going to copy them down. Then we're going to say additional PR expense. So that's like, 401k, benefits, all that stuff. Okay, so now we have to list salaries out. So, we're talking about an early stage startup. So CEO usually takes one of the lowest salaries in really early stage businesses because they have the highest stake. And okay, let's say some engineers are 100K, marketing 75K, 60, 40, 40K here for whatever this role is. So here all we need to do is take this, we're going to lock the column so that you need the dollar sign in front of the A. That's just going to allow when we copy this formula, for the formula to go up and down, but not left and right. And we're going to also divide this by 12. So here you'd get 5,000 per month times the amount of people in the role, so 1. So what we can do here is we can basically just copy this across, and you'll see that we will have the payroll for each month for the whole crew. Okay. So now the PR expense, so basically what we do here is we just add up all this payroll, multiply it by the 25%, and then that gives us sort of the additional cost, and we just add that up. So pretty simple here, and we're saying that our personnel cost gets to 71K at the end of year 3, and it's about 25K per month during year 1. Okay, so what else do we have going on in OpEx? So let's kind of look at this. So of course, we're going to have consultants, probably a lot of consultants in the beginning. Generally, you don't have that many full-time employees in the beginning, but you often have, many consultants. So let's say you have a bookkeeper, legal, marketing, software development. Yeah, that's probably good. So software development. Okay, so we can delete that row in here. So we're just going to kind of make up some numbers. We're going to say bookkeeper, we pay $2,500 a month to someone who's sort of like an outsourced bookkeeper. And then legal, let's look at some of these other expenses. So legal, let's say $1,000 a month. We try to do as little as possible. Marketing, $10K a month. So we have some marketing consultants, software developers, $10K a month. So let's just kind of, or let's say $5K a month. $5K a month. Okay, great. So maybe this gets us through to year 2. So we get to month 13, and then we need more help in terms of marketing. So these are maybe some, media buyers or PR agency, something like that. So what we can do now is just take those, and let's just say this is our kind of consultant budget through the end of the model. Okay, so we have our consultants. What other OpEx do we have? Well, we definitely have marketing. So we know we have the ad spend from up above. Let's say we also have like other marketing. So this could be all kinds of stuff, payments to influencers, et cetera, et cetera. And so for this, maybe it's, let's say 25, let's say it's 0 in the beginning. But as we start to kind of scale, maybe by year 2, it gets to 5K a month. We start paying influencers and other people like that. And then we would have like just technology, general technology. So like mostly subscriptions, etc. Enterprise software. And let's just put in a mixed fixed expense. This is what I call like a slush fund. It's like, okay, you're going to spend money on other stuff, travel, this, that. You don't really know exactly what. Just put some money in there so that you have sort of appropriately put something in the model to cover, things that you don't know how much they'll cost and when you're going to do them, but there's some budget in there. Okay, so this maybe it goes to 5K, and then maybe in year 3, let's say year 2, this is fine, and then in year 3, let's just say this goes to like 10K. You need more software, and there's all kinds of other random stuff coming up that you need to do. Okay, great. So now we can finish up the income statement here. So let's just add those things in. So, okay, so what do we have here? We have, I think to start out, we have our ad spend. Okay, so we have ad spend, then we have other marketing. So you kind of put the marketing together. We have consultants, technology, and miscellaneous expenses. Okay, ad spend. So here up above, where was that? Okay, paid advertising here, 11,000. Other marketing here, 0 in the beginning. Consultants, looks like I need to fix that formula. Okay, there we go. Consultants there, 13,500. Technology here, miscellaneous expenses. There we go. Okay, so let's just format this correctly. Add it up. Copy it across. Okay, and so you can see now we've got 71K in payroll, we've got 96,000 in other OpEx. So the total is just these two things added together. And then your operating income is your revenue minus your COGS, which is your gross profit, minus all of these expenses, is negative 57,000. So I'm saying this is our burn rate. And the reason why is because we don't have any non-cash expenses in the P&L. So a non-cash expense is when, for instance, you do software development, and instead of putting it on your income statement, you actually put it on your balance sheet, and then you depreciate the asset over a number of years, which means if you put $1 million in, you would basically say, okay, we're going to use this thing for 3 years, so we're only going to put $333,000 of expenses on the income statement per year. In that situation, you need to build out the income statement, the balance sheet, and the cash flow statement. But because for us, everything on the income statement represents the cash that went out of the business and came into the business. This is a cash-based income statement. Our operating income and our cash burn line up, and they're the same number. So this makes your life easier if you do that. Okay, so we have this number. And now I'm going to show you a couple ways to just kind of forecast your burn and to think about this. So one thing we want to think about is a tax loss carry forward. So what is a tax loss carry forward? Basically, any negative income you've had, you can use it to offset future profits, and you don't pay tax on that until your profits have exceeded all of the past losses you had. So you want to basically keep track of how many losses you had in the model. So here it is. And all you're doing is basically taking the prior month and just adding it to the current month. So this is the accumulation of all of your losses. So once you start turning a profit, you're not going to have to pay taxes until your profits have exceeded all of your losses. So this is kind of a cool trick. Here, all you need to do is basically say, only calculate taxes. So if this number is greater than 0. So only if once you've offset all of your losses with profits. So if that number is, let's say, less than 0, this is an if statement, then don't have me pay any taxes. If it's greater than 0, then what you're going to do is you're going to take this number right here, your operating income times, let's say, 25% income tax rate. And so later in the model you'll see, but this is actually a really, really helpful way of kind of tracking when you're going to have to pay taxes. So here you just take your operating income minus any taxes paid, and that's really your kind of cash flow. Okay, so let's say we raised $1 million right at launch. Like maybe we were building the product with a couple $100,000 before that, and right when we launched to start generating revenue, we raised $1 million. So we know that our cash is $1 million plus whatever our loss or gain is. And so runway is basically how much cash do you have divided by how much money did you burn. So 16 months of runway at this point. So here your cash is just prior month's cash plus how much you made or lost plus any new cash into the business. So here's your runway. Okay, so now let's copy all these formulas over so we can kind of zoom out and really figure out what this is telling us. Okay, so zoom out a little bit here. So first off, do we pay taxes at any point in the model? No, we only turn a profit at the end of year 3, and we have basically $1.8 million of losses that we can offset our future profits with. So that's helpful. One thing you can see is our cash balance went negative. So that means that we didn't have enough cash. We'll need to raise more cash at some point in the model. So we raised $1 million here, and we can see our cash balance going down. And so this model would tell us, okay, at what point do we want to try to bring more cash into the company? You see your runway declining very quickly around the end of year 1. So you probably would want to bring more money into the company around the end of year 1. Now we can kind of look at, how much money do we really think we are going to need? After the end of year 1, we're burning sort of $100K a month for a number of months. So, $1 million, $1.5 million really extends your runway from, less than a year to kind of like 2 years. That's, pretty decent. And then it seems like with that cash infusion, we're actually able to get to the point where we start turning a profit and break even. And at that point, we won't have to fundraise anymore. So, and then one quick thing, if you want to, you can just go to the page layout tab, and on these view grid lines, you can take them away. Some people like their models without grid lines. I sometimes like my models with grid lines, but you can always just take them away if you want. And so it looks very clean like this. Okay, so I hope this video helped you understand how MarTech startups work and how to build a financial model for one. By the way, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. And as always, in the description below, you can download this MarTech financial model completely for free. And if you found this content valuable, please like and subscribe. Only 10% of my viewers subscribe. Thanks for watching, and I'll see you in the next video.